Hello everyone, now we will start with an introduction to accounting standards. Now about accounting standards, you did have a brief understanding when you were at CA Foundation, or those of you who have come through direct entry, you have also learned about accounting standards as a part of your BCom syllabus. Okay. Now what are accounting standards, why do we need them, everything we will be discussing in this particular chapter. If you want, you can do this chapter towards the end after completing remaining standards as well. Okay. Now, sir, why do we need accounting standards? Let me give you a very simple example, and you yourself will come back and say, sir, this is why we need accounting standards. Say, for example, I want to start a business. Okay. What do I want to start? I want to start, let us say, semiconductor business. Okay. A lot of hype around semiconductor going on, and with the increase in technology usage and AI and all of those things, semiconductors will be in huge demand. So I want to start a semiconductor business. For this, what did I do? I purchased a machinery. For 1 crore. Okay, I purchased a machinery for 1 crore. I also purchased some patented technology. Means how to manufacture, what should be the process and all of that. I paid another 1 crore for this, and I established my plant. I spent a lot of money on land, buildings, everything, and I started a plant. First year I could manufacture very little, and what I got was, I got sales of, let us say, 50 lakhs. Okay, and I incurred other expenses. Other expenses related to salary, everything put together. I incurred expenses of, let us say, 30 lakhs. This is my broad scenario. Now, what I want to do as a company is that all of this amount that I have invested, I want to treat it as my expenditure in the first year itself. So, what I say, this machinery expenses plus this patented technology expenses, another 2 crores, I say these are my expenses. Okay. And I want to report a profit, or in this case a loss of 180 lakhs. So I have declared a loss of 180 lakhs. Next year what happened? Next year my production increased and my sales increased. Next year my sales became 100 lakhs. My expenses was around 40 lakhs, and now I want to show a profit of 60 lakhs. Now you tell me, as future chartered accountants, is this the right approach? You will immediately jump in and say, sir, this is not the right approach. It is violating the matching concept. You are not doing the accounting properly. For machinery and all, we need to charge depreciation. Correct or not? This is what we have learned as a part of our accounting in 11th, 12th and foundation. And you will come and say, sir, this is not the right way to do the accounting. You have to account it properly. You have to follow accrual concept. You have to follow matching concept. For this machinery, this will give us a benefit over a period of time. So I cannot take it as expense in the first year itself. Correct or not? What are you telling me to do? You are telling me, sir, you have to follow some accounting principles. You have to follow some kind of framework. You have to follow some kind of rules. Only then your accounting will be correct. Now, if you look at businesses around you, there could be one kirana store, there could be one pani puri wala, there could be one tea stall, correct? There could be one supermarket, or you may go to a Reliance retail store, or you may go to a Chroma store. You will see a lot of businesses around you. Then, if you look at all of these businesses, maybe a kirana store or a pani puri wala is not bothered about accounting at all. What he thinks, every morning I will put up the stall, I will make so much of sales, this is my expense, whatever is left as cash in hand is my profit. Correct or not? But if I move towards, let us say, companies, and I gave you one example of, let us say, you can look at maybe Chroma store, or you can look at maybe Reliance retail store, or you can look at any other store for that matter. All of these are companies form of organization where there are investors. Investors have put in money into these companies. Now these companies cannot do any random accounting like this. You need to have a proper structure when you do the accounting. You need to have proper rules when you do the accounting. So to ensure that the business organizations follow proper accounting rules, so that they report the profits properly, they report the financial position properly, they tell you how much of assets are there, how much of liabilities are there. To do all of these properly in an appropriate manner, we have accounting standard. The name itself suggests, right? Accounting standards. Standard means what? A common base or a common set of principles for us to follow when we are doing the accounting. Like you said, this machinery cost of 1 crore, if I am using it for, let us say, 10 years, I will charge the expenses over a period of 10 years. Even in that, it may be possible that initially I get more and more benefit and later on I get less benefit. Then I will follow something called as written down value method. All of these concepts you are already aware of. Now in CA Inter, when we do accounting standards, when we learn accounting standards, we will understand that here for each of these items, we have a set of principles, we have a set of rules, we have accounting policies, we have accounting guidelines, everything coded as accounting standards. Okay. So the idea is company's form of organization should follow accounting standards. Okay. But sir, what about that small kirana store, or what about a partnership firm, or what about other, let us say, trust, apartment association? Do they also need to follow accounting standards? So typically what you need to understand is, when we talk about accounting standards, one is the company form of organization. You see a lot of companies around you, right? So one is a company form of organization. Then we have non-companies. In non-companies, we have all of these individuals, partnership firms and all of those that come into picture. Okay. As far as companies form of organization are concerned, they must follow the accounting standards, and this is prescribed by none other than our Companies Act. Under the Companies Act and rules made thereunder, you are required to follow accounting standards. Okay, for companies it is very clear, and if you remember, I showed you an annual report of a company in the introductory part. So they need to follow accounting standards. So then what about these non-companies and all? For this, if there is a law which states that you have to follow the accounting standards, then you need to follow. If there is no law, but if there has to be audit being carried out under any law, then the chartered accountant who is doing the audit has to mention or has to report on whether the accounting standards have been followed or not. Are you getting my point? For companies, it is required, mandatory. For non-companies, through chartered accountants, we need to ensure that yes, whether those enterprise have followed accounting standards or not. Okay. So that is where accounting standards are used, and all the CAs are governed by ICAI. And ICAI ensures that through chartered accountants, whenever a chartered accountant is auditing a non-company form of organization, they have to check and ensure whether the accounting has been done as per accounting standards. Okay. So this is the background. What does the accounting standard do basically? Accounting standard gives us a common set of principles, common set of rules, common set of policies which the businesses have to follow, which an enterprise has to follow while preparing and presenting their financial statements. Okay. So that is what is a accounting standard. I will come to the proper definition and all of that, but for you to give a perspective. So am I saying that all Indian companies need to follow accounting standards? Yes, all Indian companies need to follow accounting standards. Now let us say there is an Indian company which is Reliance Retail. Okay, they have to follow accounting standards. Now if a foreign investor or if a foreign company is looking at Reliance Retail, they know this Reliance Retail has to follow accounting standards. These are under the Indian regulatory framework. But today if you look at companies, multinational companies, all of them operate in something called as a global environment. Okay, we are not restricting ourselves to domestic business or domestic sources of capital. In fact, companies like Infosys is listed in the US also. They are listed in India, they are also listed in the US. Now, if a company in India is listed in the US, the US authorities will say, yeah, we don't want financial statements as per your accounting standards. We need financial statements as per global accounting standards. So, what India has done is, from accounting standards, we have moved to Indian accounting standards, which is based on International Financial Reporting Standard. So, there is a Indian framework and there is a global framework. Okay. When I say framework, what I am saying is there are set of standards for India. There are set of standards applicable globally or followed globally. Okay. So, because businesses were growing, foreign capital was being brought into India, foreign investors were coming to India, Indian businesses were investing outside, right? Because of all of this, what Indian government decided is we have to be in line with International Financial Reporting Standards. Okay. Now, this International Financial Reporting Standards, based on this, we follow something called as Ind AS. Sir, who follows Ind AS and who follows AS? Ind AS are followed by larger companies. We will come to it, to which companies is this applicable. To the companies who do not follow Ind AS, they have to necessarily follow accounting standards. Okay, they have to necessarily follow accounting standards. Okay. Then, for non-companies, there is no rule which tells them that you have to follow the accounting standards, but if a chartered accountant is auditing under any other law, they have to certify or they have to give an opinion as to whether the accounting standards have been followed or not followed. So, sir, what does this accounting standard tell us? Accounting standard tells us how you should account for some transactions. Accounting standards tells us what all should you disclose in the financial statements. Accounting standards tells us what all should you do when you recognize an asset, when you de-recognize an asset, when can you recognize an asset, when should you de-recognize an asset, on which date, at what amount. So, they tell us what all we need to do for accounting purpose. They also tell us what all we need to disclose as a part of financial statements, right. So, that is what is accounting standard. So, as a part of this introduction, so now we have understood a background of accounting standards and we know this forms a significant part of our syllabus for CA intermediate, and we have accounting standards from 1 to 29. There were actually, I would say, a total of 29 accounting standards, out of which 2 accounting standards, accounting standard number 6 and 8, these 2 are no longer applicable. Remaining accounting standards are applicable. Okay. Now, sir, what does this accounting standard tell us? So, I will give you a brief overview before I talk about what are accounting standards and all of those things. Accounting standard 1 talks about disclosure of accounting policies. So, this basically talks about notes to financial statements. Whenever a company or any other entity prepares and presents its financial statements, they have to mention what are the accounting policies that they are following. Okay. Sir, but we don't know anything about accounting policies. Don't worry. Step by step we will understand everything. Okay. When we say accounting policy, basically we are saying that how have they accounted for some specific transaction. A simple example for you, is it SLM basis depreciation or WDV basis depreciation? That is an accounting policy. Okay. You have to tell specifically whether you have followed SLM or whether you have followed WDV while preparing the financial statements. Okay. So, if you see here, depreciation on property, plant and equipment is provided on written down value method over the useful life as prescribed under Part C of Schedule 2 of the Companies Act 2013. So, what are they saying? They are saying that we have followed WDV method. This is an accounting policy. This you have to disclose in the financial statements. Sir, what is the need to disclose? Because if I am comparing 2 companies, one company is charging as per SLM, one company is charging as per WDV, their financial results will be different, their profits will be different. So, to have comparability or to have an understanding, how have they prepared the financial statements, that is where we need to disclose, see, including what is the useful life, that also they have disclosed, and they have said the life prescribed under part C, as per part C of schedule 2, they have taken the life. Okay, that is one. Then on inventory, how have they valued the inventory? Even that also they have disclosed. Okay, so what are the policies for treating specific items? You need to disclose that in the financial statements. Then valuation of inventory is covered by accounting standard 2. So how to value inventory, how to measure inventory, it is covered into a lot of basics of this. You have already learnt as a part of CA foundation. Okay, then 3 talks about how to prepare cash flow statement. 4 talks about how to handle contingencies and events occurring after the balance sheet date, slightly an advanced level standard. Then 5 talks about how to compute profit and loss, what to do with prior period items and changes in accounting policy. So here we said we will disclose the accounting policy. Here it says if we change the accounting policy, what is to be done. Okay. Then 7 talks about construction contracts. 9 talks about how to do or how to carry out revenue recognition. When should we recognize revenue? When should we book a sale? This is what is covered under 9. 10 talks about property, plant and equipment. So 6 earlier, whatever we used to talk about depreciation is now merged with 10. 11 talks about effects of changes in foreign exchange rates. If we are importing, if we are exporting, what is to be done? How do we account that? 12 talks about government grants. So if government has given us some grant, how do we account for that? 13 talks about accounting for investments. If a company has invested some amount in some other company, then how do we do the accounting? 14 talks about accounting for amalgamations, like let us say Vodafone plus Idea. Okay. 15 talks about employee benefits. 16 talks about borrowing cost, interest expense. See, I am giving a very simplified version of these accounting standards, and we have covered that as a part of introductory syllabus also, but still the more number of times you see, the better you will be able to recall, and this is our bread and butter for advanced accounting. Okay. Then segment reporting, when you have different business segments. Related party disclosures, if there is a related party transaction with director, Reliance Industries pays salary to, let us say, Anant Ambani. So that is a related party transaction that you need to disclose. How to account for leases? If we take a building on lease, how do we do the accounting? Earnings per share. Then consolidated financial statements. This typically happens when there is a group of companies, like let us say Tata Sons is there. Tata Sons has multiple different companies under their umbrella. So that part of it. Income taxes, investment in associates and joint ventures. This we will understand later. Any operations we are discontinuing. Interim financial reporting, we are preparing, let us say, quarterly financial report. Intangible assets, the example I gave, right? Machinery or technology. So machinery is tangible asset. Machinery accounting is covered under accounting standard 10. Technology accounting will be covered under accounting standard 26. Then impairment of asset, if there is any damage or loss to an asset, and provision, contingent liabilities and contingent assets. Okay, so these are the accounting standards. Applicable from which date is also given. So as early as 93 you can see. So do we need to also remember these dates? Not at all required. Okay, it's a waste of time. Sir, but what if they ask in MCQ? 2 marks versus the time required for you to remember. Okay, so that is one thing you have to keep in mind. So some standards, if you see, are as old as 1st April 93. 1st April 93, and we are what, 30 years, 30 not 30, almost 35 years ahead. See, 1st April 93. Such old standards are also being followed. So these are the accounting standards. Now what all will we cover in this particular chapter? One is what are the objectives and benefits? How do we set the accounting standards, or how are accounting standards created? That process. List of A's, just now I told you. Convergence to global standards. Why do we need to converge to global standards? So just understand, company does accounting. They may be doing accounting as per accounting standards applicable in India. But if you have to be a global company, if you need to attract global investors, if you need to get money from foreign investors, they will want, boss, your accounting standards are okay, prepare financial statements as per international standards, and that is where we had, as I told you, Ind AS. Okay. We will also understand briefly about international financial reporting standards and convergence to IFRS in India and roadmap plus carve-ins and carve-outs. Don't worry about new terminologies. everything will be covered properly in a very, very simple language as much as possible. Alright. Now, here what we did not discuss or list out, or we don't have we don't have it as a part of our syllabus, is this called US GAAP. So, US GAAP is another set of accounting standards followed by US based companies. Okay. So, US GAAP is largely followed only by the US based companies. IFRS is followed globally. So, IFRS is followed in UK. IFRS based standards are followed in, let's say, India, China. Okay. So, there are some countries which directly follow IFRS. There are some countries which say no need to follow IFRS as it is, we will modify some aspects and then you can follow it as per the modified version. So, then what is this, why US did not follow IFRS? So, they have their own set of mindset, own set of philosophies, and the simple thing like you have this color versus color, rest of the world write like this, US will write like this. Okay. So, that is just a passing remark for that matter, but US GAAP follows a different set of accounting standards which is rule based accounting standard, whereas IFRS is something called as a principle based accounting standards. I will explain this too. I will explain these concepts in detail subsequently. So far what we have understood, we need accounting standards. We need accounting standards to have standardization in accounting. That is why we need accounting standard. Okay. Now, I hope you are clear with whatever we have discussed till now. If any question arises, there is a ask query option. You can ask and get your doubts clarified. Okay. Now, when we talk about accounting standards, we need to understand one term, generally accepted accounting principles. Generally accepted accounting principles. This is called as GAAP, not GAAP, GAAP, GAAP. Generally accepted accounting principles. What do you understand with this? Some set of accounting principles which are generally accepted. Generally means commonly accepted in the accounting profession is called GAAP. Now, the GAAP can be Indian GAAP. I gave you an example of US GAAP. Alright. So, like this, which kind of accounting principles are generally accepted is given by GAAP. GAAP refers to a common set of accounting principles, standards, procedures that a business reporting entity must follow when it prepares and presents its financial statement. So, what are we saying? There is an entity. Okay. There is an entity. Please remember, I am not using the term company. I am saying entity. Entity means one particular enterprise, one particular company, one particular business. So, what we will use the term for that? Entity. A reporting entity must follow what? Accounting principles, principles of accounting. So, we have learned, right? Accrual basis of accounting, then there must be consistency, there must be matching concept, we follow going concern, right? We follow accrual basis, right? All of these are what? Principles. Standards. Okay, so all of these accounting standards that we are talking about, and procedures. What is the process of doing the accounting that a business reporting entity must follow when it prepares and presents its financial statements? Now, please remember, see, I am putting a lot of emphasis on these small words. Though they are not very significant from examination point of view, you must know the difference between prepare and present. What is the difference between prepare and present? All of you have answered questions in your 11th or in your foundation or in your 12th. Prepare profit and loss account and balance sheet. Yes or no? Prepare profit and loss account and balance sheet. Now, when you prepare profit and loss account and balance sheet, you generally follow what? T-shape accounting. You will do trading account, you will do P&L account, and then you will prepare the balance sheet. This is called preparation. So, then what is presentation? In what format should you prepare the balance sheet? In what format should you present the balance sheet? I am not talking about drawing lines and presenting it neatly. A specific format. For example, if you are preparing a company's profit and loss account, you will not prepare in this T shape. There is a specific way to present it. For example, if I look at this particular company, there is a specific way in which they are presented: equity, shareholders, non-current liabilities, current liabilities. There is a specific format. Okay, yes or no? Then P&L also there is a specific format. Then they have said significant accounting policies where they have disclosed all of the accounting policies. Then when we talk about presentation, I will give you one more example that will help you understand what we are talking about in presentation. Property, plant and equipment. In which standard will we learn this? We will learn about this in accounting standard 10. Coincidentally, this also is number 10. Now here you see what are they presenting under assets, all the classes of asset. What was the opening balance, what was the addition, what was the deletion, what was the closing balance. So accounting standards tell us what all do we need to disclose in the financial statements. Okay. So that is about presentation. So what are we saying? We are saying that the common principles, the common standards, the procedures, the rules that a business entity or a reporting entity must follow. Sir, who is this reporting entity? The entity which is preparing the financial statement is the reporting entity. So the reporting entity must follow to what? To prepare and present the financial statements are called generally accepted accounting principles. Okay. Now if I have to just ask you one simple question that will help you improve your understanding. What is the generally accepted rule of driving in India? Will you drive on the left side or the right side? Of course, there are a lot of people who drive wrong side, but generally accepted driving side is left hand side, correct? But let us say you go to Dubai, there the generally accepted riding rule is on the right side, correct or not? So that is what is generally accepted. So here also we are talking about generally accepted accounting principles. The GAAP comprises of authoritative standards, basically standards set by policy boards and standard setting bodies, and commonly accepted ways of recording and reporting accounting information. So one, we are talking about standards, authoritative standards. Authoritative standard means something which has authority. Sir, are you saying that these accounting standards have authority? Yes, they have authority. They have been notified under law. Accounting standards for companies is notified under law. So we have authorities like National Financial Reporting Authority, we have Institute of Chartered Accountants of India, we have Ministry of Corporate Affairs. So they prepare these standards and ultimately Ministry of Corporate Affairs notifies this standard. So these are authoritative standards, one. And second, GAAP includes commonly accepted ways of recording and reporting accounting information. How do you normally record? Okay, in a particular country or in a particular, let us say in a particular geography, how do you record that? That is also covered under GAAP. I will give a very simple way. In India we have this thing, bank account debit to something. If you go to foreign countries, let us say if you look at US based accounting, they use debit bank, credit something. Both of them are right. But how do you actually record it? See, now of course use of ERP and all of these becomes irrelevant, but this is a very small example to tell you how do we record transactions. Okay. At the international level, the authoritative standards are known as International Financial Reporting Standards, IFRS. In India we have authoritative standards named Accounting Standards and Indian Accounting Standards. Sir, we are saying in India we have accounting standards. And again we are saying we have Indian accounting standards. Why do we have two accounting standards? These accounting standards are the accounting standards which was issued, you saw right, first standard being issued in 93. Since then a lot of accounting standards were issued. These are slightly simplified versions of accounting. Just to give you a perspective, revenue recognition under AS 9 is a very small standard. Hardly maybe 5 or 6 pages you will be able to understand everything. You go to revenue recognition under Indian accounting standards, even 100 pages will not be sufficient. That is the level of depth. Okay. So accounting standards were earlier issued as per the requirement at that point of time. Now if I have issued one accounting standard in 1990s, after 3 decades, do you think it will be still relevant? It will not be, right? So we have to move to the globally accepted standards. So these accounting standards are the earlier standards which we also consider to be or refer to as Indian GAAP. And then we have Indian accounting standards. These Indian accounting standards are based on international financial reporting standards. Okay, I am again repeating, accounting standards were issued earlier. Ind AS are issued after 2000. Ind AS have been made mandatory after 2016 for some specific type of companies. Okay, so these are latest ones. Ind AS is based on international financial reporting standards. So does that mean accounting standard is not based on international financial reporting standards? Some of the accounting standards are based on IFRS or IAS. Okay, a lot of them are slightly more simplified. For some of the items we don't have accounting standards. For some of the items we don't have accounting standards. So just to give you one perspective, whatever you learn as AS2 is 99.99% same as what you learn in Ind AS 2 and what you will learn in IAS2. IAS2 is International Accounting Standard. Okay, but if I ask you Accounting Standard 9, what you read in Accounting Standard is only 20% of what you will understand as a part of Ind AS or IFRS. Okay, so that is a level of difference. And for some specific items, we call, let us say, accounting for financial instruments, we don't have accounting standards. Okay, so we have two sets of accounting standards, but sir, you didn't tell the reason for two sets. Accounting standards is for other companies, the smaller companies. Ind AS is for listed and larger companies. Okay, so Ind AS is followed by listed and larger companies. Accounting standard is followed by other companies. And not only that, accounting standard is also followed by non-company form of organization. Let us say some partnership firm is there or some sole proprietor is there who wants to follow some accounting principles, they will refer to accounting standards. They will not be in a position to implement Indian accounting standards, it will be very much complicated. Alright, so we have GAAP. GAAP consists of accounting standards, and in India we follow accounting standards, that is Indian GAAP, and also Indian accounting standards which are based on IFRS. So now we have understood the basics of what accounting standards are, and I gave you a brief idea of why accounting standards are required. Okay, so moving ahead, what are accounting standards? Accounting standards are written policy documents. What are these? These are written policy documents, means they are in writing, they are policy documents. Sir, what kind of policy documents? Accounting policy documents issued by the government. Now, when we say issued by the government, we have different ministries under the government, and for companies, Ministry of Corporate Affairs will issue the accounting standards or will notify the accounting standards. Now, in all cases, it may not be necessary that the government is issuing the accounting standard. It may also be possible that sometimes bodies like ICAI, the Institute of Chartered Accountants of India, they will issue the accounting standards which will be followed by the non-corporate entities. For corporate entities or for companies form of organization, we have the Ministry of Corporate Affairs, and for non-corporate form of organization, ICAI will notify the standards or issue the standards. But please remember, ICAI is not a legislative body. It cannot make laws. It cannot force someone to follow the standards. But what it indirectly does is, whenever the non-corporate entities are being audited by chartered accountants, institute requires the chartered accountants to give an opinion on whether the accounting standards have been followed or not. I am not saying accounting standards are mandatory for, let us say, a sole proprietorship, but if, let us say, I am running a sole proprietorship business and I have to get my accounts audited for, let us say, maybe submission to the bank or for income tax purposes, in that case, the chartered accountant who is auditing, when he issues the audit report, he has to specify whether accounting standards have been followed or not. Okay, so just for your better understanding, because you are new to the subject, if let us say I am a sole proprietor, I want to get a loan from the bank. What does the bank say? Bank says, boss, you go and get your account audited and get a report from a practicing chartered accountant. So you go to a practicing chartered accountant, or I'll go to a practicing chartered accountant. Let us say you are the chartered accountant. Okay, and I'll say, boss, I have to give this financials to the bank. The bank wants an audit report. Can you audit that and give an audit report? You will say, okay, I'll give an audit report. What's the harm? Right? So you audit it, and when you are giving that audit report, you have to specify whether accounting standards have been followed or not. Sir, what will be the problem if you don't follow the accounting standards? If let us say I have not followed the accounting standards and I give that report to the bank, and the bank will say, "Arey, you have not followed the accounting standards," means you have not prepared your books of accounts correctly. Maybe the profit that you are showing is not a proper profit. Maybe you have shown higher sales, lesser expenses, right? All of those things could be possible. So I would want to ensure that when the bank sees the audit report, they should get a clean audit report where the accounting standards are complied with. So this is an indirect way of complying with the accounting standards. Again, I am repeating, ICAI cannot form a law saying that all the businesses must follow accounting standards. But when a chartered accountant does an audit and the chartered accountant is a member of ICAI, ICAI can tell its members, boss, whenever you are going for audits, whenever you are preparing audit report, you have to make or you have to give your comment on whether the accounting standards have been followed or not. Okay. So that is about accounting standards, the basic meaning of accounting standard. Written policy documents with respect to accounting issued by the government with the support of other regulatory bodies. Subsequently, we will understand what is the process of formulation of accounting standards. Ministry of Corporate Affairs issues accounting standards for corporates in consultation with National Financial Reporting Authority. So there is some authority called as National, that is for India, Financial Reporting. Sir, what is financial reporting? Subject in CA final? Not that way. When we say financial reporting, we are talking about reporting of the financial statements, the balance sheet, the P&L, the cash flows and related notes. Okay, that's a financial report. So we have a National Financial Reporting Authority which will provide its opinion, which will give consultation, and ultimately who will notify? Ministry of Corporate Affairs will notify. The first step of formulation of standards is done by ICAI. We will understand that process subsequently. Once the ICAI formulates the accounting standards, those accounting standards are subsequently notified by Ministry of Corporate Affairs in consultation with National Financial Reporting Authority. Okay. Now, if this question comes in the examination, just don't write this one sentence and say I have done the definition. You also need to mention accounting standards deal with the following aspects of accounting transactions or event in the financial statement. So we have to specify what all are the aspects which accounting standards deal with, and almost all, I will not say all, almost all the standards deal with these four aspects. Or if you look at any standard, you can actually break down the standard into four different parts. Okay. Most of the standards, some of the standards only talk about presentation and disclosure requirements, they don't talk about recognition and measurement. Some standards. Okay. For example, related party disclosures. In related party disclosures, only these two aspects are largely covered, first two aspects are not covered. What are these four aspects? The first one is recognition of events and transaction. See, as far as events and transactions are concerned, you have understood in basics of accounting. We will focus more on recognition. So let's say if there is a transaction, sir, what transaction? We sold goods. We sold goods to another party. Can we recognize revenue or sales in respect of that particular transaction? Okay. Who will tell this? Accounting standards will tell us. Accounting standards will tell us when to recognize a particular transaction in the books. Sir, but what is this meaning of recognition? Recognition means when do I record or when do I pass the journal entry, to be precise. When do I pass the journal entry for a particular transaction? Alright. So, if there is a sale transaction, if there is a purchase transaction, or we are, let us say, constructing a fixed asset, property, plant and equipment, or let us say we are issuing equity shares, or let us say we have purchased certain items. Okay. When should we record those transactions in the books of account? Now, the transaction can be with respect to an asset, a liability, income, expense or equity. When should we record? That is given by accounting standards. So, for example, accounting standard 10. Accounting standard 10. See, I am repeating these numbers on purpose so that by the time you complete all the lectures, even if I wake you up in the sleep, you will be able to tell me the accounting standard number and the title. So accounting standard 10, we have a beautiful standard which deals with property, plant and equipment. We have accounting standard 10 that deals with property, plant and equipment. What you learned earlier as fixed asset, now what is the term you will use? Property, plant and equipment. See, as we move higher in the professional studies, we need to use the relevant technical terms. It is very, very important. Okay. Accounting standard 10 on PPE tells us what are the conditions to be satisfied before we recognize. So when I say recognize, before I pass this entry, property, plant and equipment to, let us say, bank or payable, when can I pass this entry is defined by the standard. Okay. So when we go to AS 10, that is when we will understand when can I recognize a property, plant and equipment, or when can I recognize an intangible asset, when can I recognize interest expenditure, when can I recognize a sale. All of these things are given to us by accounting standards. Now when I have to recognize something, when I have to pass a journal entry, one is I need the date, I need the account. So here I said this is covered by AS 10. Then I need the amount. At what amount should I capitalize the property, plant and equipment? Even that is given by accounting standards. Amount we say to be a measurement. How should I measure income, expense, asset, liabilities, equity in my financial statements is given by accounting standards. Not only measurement at the first time, subsequently also how should I measure is given by accounting standards. All of you, if you remember in your earlier studies in your CA foundation or maybe in BCom as well, you have learnt about depreciation, you have learnt about revaluation model briefly. So how to measure initially and subsequently is given by the accounting standards. Then one is recognize, second is measurement, third is how should we present current assets, non-current assets, in which order should we present, that is also given by accounting standards. And lastly, what all should we disclose in the financial statements. Like I gave you some examples, right? Disclosure in terms of which method of depreciation have we followed, what is the useful life, what is the accounting policy, everything we need to disclose. So most of the standards deal with all four items related to a particular item in the financial statements. So if you go to property, plant and equipment, accounting standard 10, it will talk about when do we recognize. Alongside recognition, we also talk about derecognition. Recognition to bring into the books, derecognition to move it out of the books. Okay, recognition to bring it into the books, derecognition to move out of the books. When do we move it out of the books? So, say for example, when we sell that particular asset. Okay. Then measurement, at what value should we record? How do we present that? What is the classification we should give? What all are the items under property, plant and equipment you should disclose, and what all things you should disclose is given by the accounting standards. So accounting standards deal with recognition, measurement, presentation and disclosures. Recognition, measurement, presentation and disclosure. The main purpose of standard setting bodies is to ensure that timely and useful financial information is provided to investors and other stakeholders. Subsequently, we will understand about users of financial statement. So, what is the objective? Timely and useful. You should provide useful information and you should provide timely information to the users of the financial statement. Now, again, what is the meaning of useful? And again, what is the meaning of useful and what is the meaning of timely? Say for example, we are looking at Reliance Industries financial statement. Assume for a moment turnover is 5 lakh crores. Turnover is 5 lakh crores. Now, in the financial statement, let us say there is printing and stationery expense of 5,000, just for example. Okay, I know it will be much higher, but just for example, printing and stationery expense is 5,000. And they have presented or disclosed this expense as a separate line item in the P&L. In the breakup of expenses, they have said we have spent 5,000 in printing and stationery. Now tell me one thing, is this a useful information? For a company which is doing a turnover of 5 lakh crores, is 5,000 of expenditure actually a useful information? It may not be useful information, correct? And generally, if you look at printing and stationery, 5,000 means nothing in 5 lakh crores. So, when we prepare present financial statement, we need to ensure that useful information is provided, irrelevant information is not provided, and for this we use a technical term called as materiality. Is the information material? Sir, material means, is the information significant? Is the information relevant? Is the information useful? Based on that, you have to present the items in the financial statement. Just because you have a long trial balance doesn't mean that all the items should be presented in the financial statement separately. What will you do? This you will club under other expenses. You will club under other expenses. Okay. So it has to be one useful. Now it may also happen that, let us say, this 5,000 was paid as penalty of violation of a very serious law. Okay. Let us say the law is related to child labor and they paid 5,000 as penalty for violation of child labor laws, just for example. Alright. In that case, do you think this information is relevant? Yes, in that case this information may be relevant. So you have to see, just don't go by the amount. Okay. You have to see, let us say we paid 5,000 to the relative of the director. In that case it may become relevant. So we have to see whether the information which is useful is provided or not provided, and provided in a timely manner. Now see, we are in the age of information technology. Speed is very, very important, not on the roads, in terms of disclosures or in terms of publishing the financial statements. Okay. So if let us say we are in by 31st March of year 1, we are preparing financial statement for this. We publish the financial statement on 30th September of year 1 after 6 months. In 6 months, business would have changed, business environment would have changed, new technologies would have come up, government would have changed the rules, right? So many things when they change, such kind of delay will actually make the financial statements of no use. So what the standard says is, or what the purpose is, that we have to provide timely and useful financial information to the investors and other stakeholders. Investors, other stakeholders, users will come to it separately. Alright. These users are interested in the company's economic performance. So the users, the investors, the stakeholders like lenders, the bankers, the government, all of these are interested in the performance of the company. We have to give them timely and useful information. Okay. Now what accounting standards seek to do is to reduce the accounting alternatives available while preparing financial statements, thereby ensuring comparability of the financial statements across the enterprise. Now one fundamental purpose of having the accounting standard is reduce the alternate accounting treatments. When we go to accounting standard 2, there you will understand that some specific methods of valuation of inventory is not allowed. Okay. Similarly, when we go to other standards, there also we will see there are some ways and methods which are given based on which we have to do the accounting. It is not that you want, you will do the accounting in your way, I want, I will do the accounting in my way. A very, very simple example is, let us say, when we are talking about companies, can company prepare financial statements following the cash basis of accounting? And the answer is no. And this comes from one, the Companies Act, second, the fundamental accounting principles or assumptions that we will learn as a part of accounting standard 1, which says that you have to prepare the financial statements on accrual basis. Now it is very clear, all the companies will have to prepare their financial statements on accrual basis. You cannot have cash basis, you cannot have single entry basis, you cannot have hybrid basis, you cannot have your own basis. Okay, so in that sense it is very important to have this accounting standards. And what does it help? It helps us to compare the performances of multiple different enterprises in the country and across the globe. Okay. Now before we move further to understand the benefits of accounting standard, one thing is accounting standards are principle based standards. Accounting standards are principle based standards. Sir, what is the meaning of principle based standards? And US GAAP are rule based standards. These two terms you remember? One is principle based standard, one is rule based standard. Sir, what is the difference? I will give a very, very simple example. Accounting standard says, and I have actually written it down, accounting standard will ask questions like, Is it substantially all of the fair value? Sir, what is this? When we go to AS 19, we will understand this. But for now, just understand this question. Is it substantially all of the fair value? Means we are saying, does it substantially cover the fair value? Does it substantially cover the fair value? Sir, what is fair value? For now, think of fair value as market price. Think of fair value as a market price. If it covers substantially, sir, how much is substantially? We don't know. It can be 90%, it can be 95%, so for some it can be 85%. So it requires judgment. Okay. Whereas when we say a rule, we say, is it 90% of fair value? Now when I say 90% of fair value, is there any confusion? No confusion. There is a rule. 89.99% will also fail this requirement. It has to be 90%. But when I say substantially, some companies may say, sir, for us 85% is also substantial. Okay. So that is where one is a principle, one is a rule. Accounting standards that we follow in India, both accounting standards and Ind AS, also the IFRS, are principle based standard. They give guiding principles. They say, okay, this is what are the various treatments you can give. Then the companies, the management, they have to choose, they have to decide, okay, these are the principles, we will follow these principles in this particular way. Okay, that is what is a principle based standard. And here you need a lot of judgment. What do you need? Lot of judgment. Whereas when it is a rule based standard, very clearly yes or no. Very clearly yes or no. So in that case there will not be any confusion. So US GAAP are rule based standards. The generally accepted accounting principles followed by the US based companies are rule based. Yes, no, a very clearly rule definition. Whereas the accounting standards that we follow in India and also the IFRS that is followed in most of the countries are principle based standards. Okay. So we have understood the part of what are accounting standards, what do they deal with, what all accounting aspects they tell us across all different standards. Now the next part is what are the benefits of accounting standards. Now when we talk about benefits of accounting standards, you need to visualize what would happen if there is no accounting standards. Now remember the first example that I gave you before I started the discussion, that the machinery expenses I will charge it off to P&L, okay, the technology expense I will charge it off to P&L immediately. If there was no accounting standard, what would happen? Everybody would do the accounting in their own way. And if two companies are following two very different ways of accounting, one is following the cash basis, another one is following the accrual basis, how will you compare them? Now you may have the next question, sir, why do we need to compare? Correct? Why do we need to compare two companies? Now think of it, you are an investor. So who is an investor? Who gives money to the company, the capital contributor. Okay. So you want to put some money into company or into a business. There are two businesses. Now to evaluate whether you should put money in those businesses or not, you will see a lot of other angles, market, and you will see the product, you will see the operations. Assume for a moment both the companies are in same line of business. Similar capacity. Factory is also located side by side, right? And the operations are also pretty much similar. Now you are looking at how are they performing financially. Ultimately, what is the goal? The goal is to invest money and make more money, right? For everybody, it is like apna sapna, money. So you want to make the maximum money. For that, you will say, okay, I will check the financial performance. So you got the financial statements from both the companies. One has followed cash basis, another one has followed accrual basis of accounting. Sir, how different will it? Sir, how will it be different? See, if you are following cash basis and if you are following accrual basis, I will just give you a very simple example. Let us say sales, total sales are 10,000, total purchases are 8,000. Assume for a moment there are no other expenses. Okay, sales 10,000, purchases 8,000. Out of this, already paid or received, 8,000 is received and 5,000 is paid. How much is payable? 2,000 is payable, receivable, and 3,000 is payable. So this is the cash movement, this is the accrual basis. Now if I follow accrual basis, I will say 2,000 is the profit If I follow cash basis, I will say 3000 is the profit. Is it comparable? No. Second, here I am saying sales is 10,000, here I am saying only 8,000. Is that also comparable? No, it's not comparable. Then again, inventory they may not value. Okay, there may be some outstanding liabilities, there may be some expenses payable. We will not know. You will not be able to compare. Correct. So, if you don't have any standard, if you don't have any benchmark, how will you compare? Right. So, just to give you a real life perspective, how are students evaluated? Based on marks. Okay. Again, I don't believe marks are the only way to evaluate the ability or knowledge of a student, but that's how generally done, right? So, you have exams conducted, then marks are given. Based on the marks, the standard marks, we compare, right? So, here also when we talk about thousands, not even thousands, lakhs of companies, if you have to compare the performance, you need to have some standard based on which they will report the financial performance. Okay. So, when we talk about the advantage, we spoke about there will be standardization and there will be comparability. You will not be able to compare till the time there is standardization. So, what is about standardization? Accounting standards help us standardize alternative accounting treatments. Accounting standards reduce or eliminate confusing variation in how events and transactions are reported and presented in the financial statement. Sir, is it necessary to remember everything by heart? No. Side headings you remember. First side heading is standardization of alternate accounting treatment. So, what do the accounting standards do? They reduce variations in treatment of various events and transactions or how economic events are treated and presented in the financial statements. When they reduce the alternative treatment, comparability improves. The standard policies reflect a consensus on accounting policies for areas such as inventory, valuation, capitalization of cost, depreciation, amortization. So, what are we saying? We are standardizing accounting policies. We are not saying there is only one policy. Okay, like for example, depreciation. You have multiple methods, but we are giving a standard approach. We are giving a standard guideline based on which you need to charge depreciation. We are giving a standard guideline on when can you capitalize expenses. We are also giving guideline on when you need to charge the expenses to the P&L. Okay, so that is the first thing. Then it is not enough to merely comply with the standards and state that they have been followed. The enterprise must also disclose the accounting policies actually used. So, we are saying we have so many accounting standards companies have to follow. Now, just by saying that we have followed the accounting standards, we are not giving a clear picture. So, instead of that, what we should do or what the standards require is you follow. You also give the disclosures of what you have followed, whether you have followed WDV, SLM, whether you have followed FIFO method or weighted average method for inventory valuation. Okay. Similarly, what have you done with various types of expenses? Everything you should disclose. So, the first advantage is standardization of alternative accounting treatments. Then, second, additional disclosures. Okay. Now, Companies Act has a schedule 3 which gives us how should you present the financial statements. Over and above that, accounting standards also prescribe what all should you disclose. Every standard, all the standard has something called as a disclosure requirement. What you should disclose for inventory, what you should disclose, for property, plant and equipment, what you should disclose, for employee benefit, what you should disclose, for related parties, what you should disclose. Everything is required to be disclosed. So, the standards tell us that accounting standards require appropriate disclosures of the policies followed and other relevant information so that readers can understand the accounting treatment given to various items. So, that is one of the most important aspect of when we do or when we learn accounting standards. Now, time and again when I am explaining, you will come across new terminologies. Just now I used one word called related parties, and you may feel, sir, we have not heard this term, and every time when a new word comes we become scared. Not to worry. Okay, right now I am explaining you the basic introductory part. As and when we go to the respective chapter, we will discuss all of these in more detail. So, then till that time, how do we understand? So, now see, when I am saying related party, what do you understand? Some party who is related to the company. Okay, like you have relatives at home, here also there are some parties which are related to the company. Okay, so we have a standard which talks about what all should be disclosed when there is a related party transaction, right. So, say for example, Reliance Industries is doing some transaction with Reliance Retail, what all should be disclosed. So, that is a part of accounting standards, alright. Then, based on the standardization, The standardization of accounting procedures improves the credibility and comparability. Credibility means reliability, okay, of financial statements, both intra-enterprise and inter-enterprise. So, what is this term? Intra-enterprise, inter-enterprise. So, there are two things. One, last year what was the performance? This year what is the performance of Reliance Industries? That is intra-enterprise. Within the enterprise we are comparing, or within the enterprise there are different business segment. My favorite example, ITC. ITC has, come on, what does it has? Cigarette business. It has hotels, partly hotels they have sold off. It has paper. The classmate notebooks that you use is a product of ITC. Then it is into agri business. It is into multiple different businesses. If you have to compare the performance of each of the business, there also standardization help. What ITC achieved last year versus what it has achieved this year, there also accounting standards will come into place. And when we say inter-enterprise, means between two companies, how is Infosys performing versus TCS? There also we need accounting standards or standardization. So, inter-enterprise comparison is comparison of financial statement of the same enterprise over a number of years, and comparison of financial statement of different enterprise is called inter-enterprise comparison. Why are we doing this comparison? Think you are an investor. You want to put some money in one of the companies. Okay, let us say TCS versus Infosys. Now, to decide among all other factors, you will also see what is the financial performance. Now, if you have to compare two businesses, till the time you have proper financial statements which are based on a proper standard, you will not be able to compare. Alright. Similarly, let us say you have already invested in Infosys. Every year you want to see whether the performance is improving or not. There also you will need a comparable financial statement. So, what are the advantages we have learned so far? The first is it helps in reducing alternative accounting treatments. Second, it provides additional disclosures. Third, it helps in comparison because of standardization. And lastly, reduces the scope of creative accounting. You know what is the meaning of creative accounting? I am not talking about some creation of some artistic financial statement, beautiful financial statements, nothing like that. Creative accounting is also known as window dressing. Sir, what is the meaning of creative accounting? There is a YouTube video of mine where I have spoken about Byju's accounting. That will give you some idea of what is creative accounting. Anyways, briefly I will explain it here. Okay. Say for example, there is a company. What does the company want to do? What is the ultimate objective of company? Ultimate objective of company is to make or to maximize their profits and performance. Correct or not? Because this company has received money from shareholders. Company has received money from shareholders. Nobody will give money for free or without any expectation. Shareholders expect what? They expect returns. When shareholders expect return, what the company should do? Company should maximize the profit. There have been many cases where companies have tried to maximize the profits or show a better performance by doing something called as creative accounting. Sir, what is this creative accounting? If I have to improve profit, I have to, let us say, if I show higher sales, my profit will be higher. It may not always be the case, but I am just giving an example. So, I want to show higher sales so that my profit is higher. Okay. So, what the company has done is, on 20th of March, it has sold goods of, let us say, 10 lakhs. Okay. It has sold goods of 10 lakhs. And the customer has a 10-day return period. All of you are aware, right? When you buy something on Amazon, Flipkart or any other e-commerce platform, some products have this return period or return policy. Now, sold goods of 10 lakhs, you have given it to the customer. Typically, you may say the sale has happened, but within 10 days, that is from 20th March, 10 days if you say, let us say 28 plus 3 in this month and 7 in till 7th of April, The customer has right to give back the goods to us, correct or not? Now, if I want to be creative in accounting, what I will do, I will show this 10 lakhs as sales in this year itself. Let us say we are talking about year 1. In year 1 itself, I will show the sales. But actually, when will the sale get completed? When the customer actually confirms on 7th April that, okay, I accept the goods, only then the sale is completed. So, by following creative accounting, you can show a higher sale in the previous period and you can inflate your revenue, you can inflate your profit, correct or not? Same way, there are many loopholes that is used by the companies to show higher profit. Another area where a lot of time these things happen is inventory. Now, let us say inventory, our cost is 1000. Cost is 1000 and we have let us say 100 units. So, how much is the inventory? Inventory we have is 1 lakh. Inventory is the stock. But the current market price is only 400. Current market price is 400. In the balance sheet, we are saying we have inventory of 1 lakh. Current market price is only 400, which means the inventory is worth only 40,000. So, if the company shows inventory at 1 lakh, what happens? If the closing stock is higher, all of you know the gross profit will be higher, the ultimate profit will be higher. So, like this, there are multiple ways of doing creative accounting and we also call it window dressing. We also call it window dressing, maybe incorrect classification. We have incurred huge expenditure on repairs and maintenance. We have capitalized that. Instead of showing it as a repair expenditure, we have shown that as an asset in the balance sheet. So, these kind of alternative treatments, creative accounting will be reduced if we have accounting standards. Please remember, we are saying reduction, we are not saying elimination. Recently, please remember, we are using the term reduction, we are not saying elimination. 100% elimination is not possible. I did one 100% elimination is not possible. If you want to understand, there are multiple different scams that you need to be aware of. There was this Satyam scam, then you had a scam of DHFL, then you had the Yes Bank issue, right? Then you had this Byju's issue, then you had this Blue Smart issue, you have this Rajesh Exports issue. So, on Byju's, Blue Smart and Rajesh Export, you can get my videos, and also as a separate module in the course, you will see these videos which you can go through. That will improve your understanding of how this creative accounting is done. Creative accounting means twisting accounting policies to produce financial statement that favor a particular interest group. Interest group means, let us say they want to favor directors, they want to show better performance, okay, or maybe possible managing directors bonus is dependent on profit, they will want to show highest profit possible. So, all of these are possible in accounting. Accounting standards help us to reduce, we cannot eliminate. There is always a manual intervention possible where people will try to overstate profit, with a simple technique like provision for bad debt. Instead of 2%, they may say it's only 1%. Now that you can't even argue, alright. So, these kind of things are reduced to some extent by following accounting standards. Now you may have a doubt, sir, in this example that you gave, that we have customer has time till 7th April to return the product, how will accounting standard help? Accounting standard will help because we have one accounting standard called AS9. AS9 tells that till the time risks are transferred, you can't recognize revenue. So, the chartered accountant who is doing the audit of the company will say, boss, the risks are not yet transferred, the risks are still with you because the customer can anytime return the goods. So, we cannot recognize revenue. Okay. So, that is how accounting standards help. So, what are the benefits of accounting standards again? Standardization or additional disclosures, comparability and reduction in creative accounting. Okay. Can be a good 4-mark question in the examination. Now, having understood the meaning of accounting standards, having understood what are the benefits of accounting standards, the next thing that we need to understand is what is the standard setting process. How do accounting standards come into existence? It is not just that one day institute realizes that we need an accounting standard and they will release something called as an accounting standard and that becomes mandatory, okay, or suddenly Ministry of Corporate Affairs notifies something and that becomes an accounting standard. It doesn't work that way. When we talk about standard setting process or how do standards come into existence, the first thing that triggers is which area of accounting do we need a standard for. Now, sir, how does this happen? I'll give you a very simple example. Earlier, during earlier days, there were very limited foreign currency transactions. Today, there are lots and lots of foreign currency transactions, right? In fact, now as we move more and more towards adoption of AI and all of those things, these transactions are just going to increase. There are a lot of imports happening, there are a lot of exports happening. So, the complexity of foreign currency transactions have increased a lot. So, when these kind of changes happen in the industry or these kind of changes happen in the business or overall economic scenario, the standard setters, who? The standard setters. So, who is the standard setter? I will come to it. The bodies that form the standard, they identify, okay, now foreign currency is an area I think where we need more clarity, or because of change in business or because of change in the way businesses are done, they feel that some standards need to be updated. For example, another area for you to understand could be, let us say, revenue. Revenue means nothing but sales. Alright. Now, traditionally or earlier, if you look at, let's say, 1970s or 80s, most of the revenue used to come from what? Manufacturing, from goods, very limited services, correct? These days, if you look at it, maximum revenue comes from services. You have said this also is a service. You are watching this class, it is a service, right? You have services by way of, let us say, telecom service, or you have the electronic commerce, you have the quick commerce, you have AI related services. So many services are being used, including the software and all of those things. So, revenue for recognition on sale of goods is much simple and straightforward. But when business complexity increases, then you will have to understand how to account for revenue properly. For example, today you can buy a router and subscribe to 1 year plan and you will get access to internet, you will get access to phone, you will get access to multiple OTT apps. How to recognize revenue? So, when that complexity arises, the standard setters, they say, okay, this is an area where we need accounting standards, right? So, then there are specific bodies, there are specific boards who will brainstorm the ideas. They will come up with some kind of draft, then that draft is circulated amongst various different regulatory bodies, right? So, let us say we want to have a accounting standard on foreign currency. They will prepare a draft. Who will prepare a draft? The standard setters. Who are the standard setters? We will come to it. This draft is circulated amongst regulatory bodies. Who are these regulatory bodies? For example, we will circulate it with SEBI. SEBI governs the stock market, the listed companies. We will circulate it amongst, let us say, we will give it to CBDT, Central Board of Direct Taxes, for their inputs. Sir, why do we need to give it to Central Board of Direct Taxes? Because the way you account for this transaction will have an impact on how you compute the income and income tax. So, they are also, involved, right? So, like this, we circulate the draft amongst all of these bodies, take their inputs, and then we will circulate it to public for public opinion or public inputs, and finally, once everything is confirmed, this is released as an accounting standard. This is the broad process. Okay. Now, one more thing that you need to understand is when we look at the Indian context, who prepares or who sets the accounting standards? We have something called as Accounting Standard Board. What is this? Accounting Standard Board. Board means basically a team, right? Under our Institute of Chartered Accountants of India, we have Accounting Standard Board. These are the standard setting authorities or bodies. But sir, sometime back you said Ministry of Corporate Affairs will notify the standard. Yes. Accounting standards are set by Accounting Standard Board. These standards are then passed on to the Ministry of Corporate Affairs, who will discuss with NFRA and then appropriately notify. Okay. So, you will identify a new area, foreign currency, revenue, or maybe financial instruments, investments related thing. Okay. Those areas are identified, the issues are identified, draft is created, circulated and ultimately notified as accounting standard. In India, we have Accounting Standard Board. Globally, IFRS and all are formed by International Accounting Standard Board. Okay, so like we have Accounting Standard Board, internationally we have International Accounting Standards Board. So in India we have Accounting Standard Board, globally we have International Accounting Standards Board. What do International Accounting Standards Board do? They prepare international standards. Indian body will prepare standards for India. Globally, across all the countries, okay, of course I said US GAAP is different, but countries which follow international financial reporting standards, these standards are developed by International Accounting Standards Board. Now, when ICAI or when Accounting Standard Board formulates a new standard, they will always refer to what is the global practice. Okay, even for accounting standard, they will refer to what is the global practice. That is why if you see Accounting Standard 2 and International Accounting Standard 2, 99% similar. Accounting Standard 10 and International Accounting Standard 16, again 99% similar. Some differences will be there, but lot of these are directly picked up from this. So as and when a new standard comes into picture, they will refer to global standard. Now you may have a doubt, sir, when internationally some body is already preparing accounting standard, why don't we simply copy that standard and say, okay boss, in India also same thing is applicable? We don't do that because every country has some sort of peculiarity. Every country has some sort of economic differences. Okay, so based on that, based on the specific Indian context, we will do some kind of changes to ensure that it is aligned with the accounting policies or accounting principles which we are following in India. Okay, so that is why we have accounting standards which are formed by Accounting Standard Board, and that is a broad process. I explained it to you. They will always definitely refer to the international bodies or international standards before formulating an accounting standard. Alright, so what is the process? So the Institute of Chartered Accountants of India, ICAI, has formulated or has set up this Accounting Standard Board, which has the responsibility of forming accounting standard. The ASB considers the international accounting standards and IFRS and try to integrate them, keeping in mind Indian laws, customs, usages and business environment. So what happened? You will form the standard by referring to the international standards, but you will customize it for the Indian context. Okay. Now, who are there in Accounting Standard Board? Representatives of industries, Association of Industries, for example, Association of what is the composition of ASB? Who all are there as a part of Accounting Standard Board? It has representatives of industries, Association of Industries. Association of Industries means India has multiple different associations like, Association of Chambers of Commerce and Industry, Confederation of Indian Industries, Federation of Indian Chambers of Commerce and Industries. So all of these representatives from industries. Regulators like CBDT, SEBI. Academicians, the one who have spent a lot of time in academics, government departments, etc. Although ASB is a body constituted by the Council of the ICAI, it is independent in the formulating of accounting standards. Okay, and National Financial Reporting Authority recommends these standards to the MCA, and MCA has to spell out the accounting standards applicable for companies in India. So ICAI has the Accounting Standards Board. They will formulate the accounting standards, then they will pass it on to the MCA in consultation with an FRA will notify. Now what is the step? First, identification of the area. So Accounting Standard Board, the first thing they have to do is whenever they feel that okay, this area needs an accounting standard, they will identify a broad area for formulating an accounting standard. As I gave you an example, foreign currency, maybe changes in revenue, okay, or there could be a revision in lease accounting, or in future we may have newer areas, okay, where the accounting standards may be used. Something like, let us say we have employee stock option plan. You would have heard of ESOPs, right? A lot of startup companies, employees are given this ESOPs, employee stock option plan. We don't have a proper standard in accounting standard. That may come up in the future. Ind AS we definitely have. Okay. So first is identification of an area. So they identify a broad area for formulating an accounting standard. After that, they constitute a study group. Okay. Now what does the study group do? The study group will study what are the nuances of the transaction. The study group will study what are the various aspects of the transaction, how it is done globally, what are the global accounting standards, what are the complexity in accounting, what is the Indian specific problems in the accounting. So they will do all of that and prepare a preliminary draft covering the objective of the standard, scope, definition, recognition, measurement, presentation, disclosure. So preliminary draft is created, first draft. The draft is revised based on group's deliberation. So again they will deliberate, they will discuss continuously, and what will the draft have? Objective of the standard, scope of the standard, various definitions of the standard, and as I told you, recognition, measurement, presentation and disclosure. So any standard you open, you will see what is the objective of the standard. So if I have to show it to you, there is on ICAI's website, there is something called as resources. In resources you can see here the first part, accounting standards, you can open that, alright. Then you have C, accounting standards, companies accounting standard rules notified by the government, Indian accounting standards. So this is, as I told you, applicable for listed companies and large companies, and then you have various guidance notes, research papers and other things. So if you open any accounting standard, they have said accounting standards as on 1st of April. So I can see the, let's say, PDF version. So you have all these accounting standards. Okay, I will open AS2. This is accounting standard 2, valuation of inventory, revised in 2016. Okay, so here you can see objective. What is the objective? The primary issue in accounting for inventory is the determination of the value at which inventories are carried in the financial statement. The standard deals with the determination of such value, including ascertainment of the cost and write down thereof to net realizable value. So it will tell us what is the scope, what is the objective. Then scope. Now what is the meaning of scope? To which all items will this particular standard apply? The standard should be applying in accounting for inventories other than work in progress arising out of construction contracts. So what are they saying? You will apply this for inventory valuation other than WIP coming under accounting standard 7. So if something is under construction, that valuation will be done as per accounting standard 7. Then work in progress arising in the ordinary course of business of service provider. So if I am providing some service and some work is in progress, that is also outside the scope. So like that they have given the scope. Okay. Don't worry, when we do AS2, I will explain to you everything in detail. Then definitions. They will define, for example, what is inventory, what is net. Here we have only 2 definitions. Some standards will have multiple definitions. After that we have measurement. Sir, why don't we have recognition? Because it is a generally understood thing that when we purchase inventory, we have to recognize. There is no separate aspect called recognition. But when you go to accounting standard 10, there you have recognition principle also. Then you have measurement. How do we measure the inventory? Okay. After measurement, then we have disclosures. Okay. In disclosure, they say what all we need to disclose. Alright. So the draft will have all of these things, and that is deliberated and that is revised after that. So once we have identified the area, we want to make a standard on, let us say, inventory or foreign exchange. Then we have created a draft. Okay. Draft is like a first note. Then the revised draft is circulated to ICAI council members and outside bodies such as Ministry of Corporate Affairs, SEBI, Securities and Exchange Board of India, CNAG, Comptroller and Auditor General. Sir, who is this CNAG? CNAG is responsible for audit of government and government related entities. Okay, you would have heard about CAG in news if you have read, but anyways, when you learn about audit, you will understand what is the CAG. Then CBDT. What is CBDT? CBDT is Central Board of Direct Taxes. Okay, Central Board of Direct Taxes. Then scope. Scope is a standard committee on public enterprises. Okay. Now, if you can't remember all the bodies, at least remember MCA related to companies law, CBDT related to direct taxation or income tax, then SEBI related to listed companies, CNAG will be a part of your audit. Okay, so you will circulate them. So the draft will be circulated. Why are we circulating the draft to all of these? Because companies come under MCA, listed companies come under SEBI, government companies will also have to follow accounting standards. So you will have to take inputs from CNAG also. CBDT, there will be taxation implication. Public enterprises, they may have some different challenges. So the draft is given to all of them and said, boss, you have to please give your comments, please give your inputs, and then after we have circulated the draft, what happens is the ASB meets these representatives and understand their views. What are your views on the draft? What all changes you want? What are the suggestions? Okay. After that, we finalize and we say it is an exposure draft. So the first draft, the draft which is circulated amongst all the bodies, inputs is taken. Then we create one more draft. We can call it the final draft, which is called the exposure draft. Exposure draft means this draft now can be exposed to the public. We can give it to the public for their comments. So if you want, you also can give your comments on the exposure drafts. Okay, I will just show you what happens. So here you can see asbcomment.icai.org, and here they have one exposure draft and they have said deadline is 30th of September. Exposure draft on risk mitigation accounting, proposed amendments to IFRS 9, IFRS 7. Based on that, what is the exposure draft? You can open it and then see they have given the detailed thing, and they have said, okay, this exposure draft you can give the comment by submitting a comment letter. Comments can be sent to so and so, or by post you can send. So whenever this draft is available, public can also comment, you can also comment. So you can just, you can see, view the comment letters, who all have given comment. ICAI Bhopal branch has given some comment. What is the comment? So the branch has given some comment, okay, with for so many items. See, ICAI Bhopal branch has given this comment. Okay, so like this there are comments which are given, and then what happens is these comments are incorporated. So when the comments are received, ASB considers the comments received and finalizes the draft, then submits it to the ICAI Council for approval. Sir, who is this ICAI Council? Okay, you would have heard of this thing called Central Council members. So what happens is the elections are conducted, and every region of ICAI, SIRC, NIRC, CIRC, WIRC, EIRC, all of these things, they elect council members who are basically the highest level of board or authority, you can say, in ICAI. So president is from the council members, vice president is from the council members. Like that we have council of members, we call them central council members, right? So the draft is given to the ICAI Council for approval. So who has to approve? ICAI Council has to approve. The ICAI Council considers the final draft and if needed modifies it in consultation with ASB. So once they receive the final draft, again they will see are there any changes required. So after receiving the final draft, once they discuss, then they will make any changes if required. After that, for non-corporate entities, the AS is issued by ICAI. For corporate entities, it is issued by the MCA in consultation with NFRA. So what is the process again? Identifying the area. Once you have identified the area, you have a study group which will create a preliminary draft. Then that draft is again discussed, and then the draft is circulated amongst the bodies. From there you will receive the comments. After that you will prepare the exposure draft. That exposure draft is given to public for comments. Considering the public comments, you will make changes and then give it to the ICAI Council for approval, and again there may be some changes, and finally for non-corporate entities, ICAI will notify the standards, and for corporate entities who will notify Ministry of Corporate Affairs in consultation with NFRA. Alright. Now, as per section 133 of the Companies Act, the central government may prescribe the standards of accounting or any addendum thereto. Addendum means any additional part as recommended by the ICAI in consultation with and after examination of the recommendation made by NFRA. So MCA, Ministry of Corporate Affairs, will also consult, ICAI will also consult NFRA and ultimately notify the standards. Earlier we used to have this thing called as accounting standard interpretations. Means if some part of the standard is not very clear, ICAI used to give accounting standard interpretations. Now what they have done is, whenever such interpretations are required, they are included as a part of the accounting standard itself. This is more for your information than remembering. Okay. Now this section 133, when you learn Companies Act, there you will understand again in much more detail how Companies Act prescribes and why it is required, how it is to be followed, and related aspects. Okay. And please remember, whenever you are preparing financial statements, it has to be in compliance with Schedule 3 of the Companies Act. So in law, you will learn Companies Act. There also you will learn about accounting. Okay, means the law related part, not the accounting part, law related part. Then when you go to audit, there also you will have references of the Companies Act. What are to be audited, how are the things to be audited. So it is a combination. It is not that I will learn accounting and I will forget, or I will learn corporate law and I will forget, or I will learn audit independently. No, when you go for learning audit, you need to know what are accounting standards, you need to know what are the requirements of Income Tax Act, you need to know what are the Companies Act. It is an integrated learning, alright. So with this we understood how accounting standards are formulated. The next thing is how many accounting standards. This we have already discussed. There are total 29 accounting standard issued. Accounting standard 6 and accounting standard 8 have been withdrawn. So in effect we have totally 27 accounting standards. Now when we learn accounting standards, as I told you, accounting standards for companies is notified by MCA. Now there also for larger companies Ind AS is applicable, which is different from accounting standard. Okay, Ind AS we learn in final, but for listed entities and for larger companies we will come to the requirement. Ind AS is applicable. For other companies which are not covered by Ind AS, what is applicable? Accounting standards are applicable. Okay. Now over a period of time, lot of accounting standards I told you, right? AS2, 10, some part of 13, not fully. Okay, also 29. These are aligned with the corresponding Ind AS and also IFRS to the extent possible. So when you go to CA final, there you will see that accounting standard 2, accounting standard 10, accounting standard 29, you will feel as if you are revising it again. A lot of things are common. In fact, you will feel it is a replica. But you know what I have seen with the students? By the time they reach CA final financial reporting preparation, they would have forgotten a lot of basic concepts. Okay. So still try to remember all the standards, and you know this will be the basis based on which you will learn CA final financial reporting. Alright, and we have already discussed the list of accounting standards. Now when it comes to companies, there is something called as Companies Accounting Standards Rules 2021. So what does this tell us? Let us see. Now when you come to this notification, what do we see here? Companies Accounting Standard Rules. You can see it on the screen, right? Companies Accounting Standard Rules. Sir, again, do we need to remember all of these rules? No, I am not saying that. I am just giving you a guidance as to how are these notified by the companies and how are these notified by the Ministry of Corporate Affairs. Okay, so what have they said? Central government, after consultation with the National Financial Reporting Authority constituted under section 132 of the Companies Act, makes the following rules. Okay, and they have made the rules and they have defined something. Accounting standard means, so they have defined something. Accounting standard means the standard of accounting or any addendum thereto as specified in Rule 3. Okay, so let us see what is the Rule 3. The central government hereby specifies accounting standards 1 to 5, 7 and 9 to 29 as recommended by the Institute of Chartered Accountants of India, which are specified in the annexure to these rules. These are the accounting standards, and all these accounting standards will come into place on or after 1st day of April. Every company other than companies to which Indian accounting standards apply shall comply with the accounting standards specified in the annexure. So what are they saying? They are saying that other than those companies to whom Ind AS is applicable, you have to necessarily follow accounting standards. The accounting standards shall be applied in the preparation of financial statement. So they have said these accounting standards have to be followed. But what they have also done is they have some relaxations for small and medium companies, which we will talk about. So small and medium companies need not comply with all the standards fully. All other non-SMCs have to comply with all the standards fully. Who are this SMC, what is this SMC and all of that, that will definitely cover when we learn about applicability and non-applicability of accounting standards. Alright. So coming back to our discussion, earlier we had Companies Accounting Standard Rules 2016, now we have Companies Accounting Standard Rules 2021 that is currently applicable. In future they may come up with a new accounting standard rule as well. So we have seen what are all these accounting standards. Accounting standards, as we discussed, are developed by Accounting Standard Board, and the institute is not a legislative body. What is the meaning of legislative body? Law making body. Who makes laws in India? The central laws are made by the Parliament. The state laws are made by the legislative assemblies of the state. ICAI does not have that authority to make laws. It can only say, okay, we have these accounting standards for companies. MCA will ensure that the companies have to follow. For non-companies, it can enforce compliance with its standards only on its members, and accounting standards cannot override laws and local regulations. So, you can't go and say, for example, let us say railways, they have a different set of doing the accounting, they have a different way of doing accounting. You may be an auditor for a railway department. You can't go and say that you have to follow this standard, that standard. They will say, no, we will follow this method only. Okay. Similarly, you go to a local trust, a municipal corporation, they will follow their own ways of accounting. Alright. So, if local laws require some specific way of accounting, you have to follow that. But for non-companies, where there are no specific rules, again, let's say Kirana store. If the Kirana store has to get its accounts audited by a chartered accountant, then the chartered accountant has to ensure, or they will ensure that in their report they write whether they are in compliance with accounting standard or not. Okay. Otherwise, the status for companies comes from where? It comes from Ministry of Corporate Affairs. Alright. Now, so far whatever we have done, we have read with reference to accounting standards, which is accounting standards applicable in India. And I have also made regular references to one more set of standards called as Ind AS, which is a part of a CA final syllabus. Difference between AS and Ind AS is more close, about 99% I can say, similar to IFRS, International Financial Reporting Standards. Now, one fundamental question that arises is, sir, when we already have accounting standards, why create one more set of Indian accounting standards? That was needed because as the economy was growing, as more and more foreign investors are coming to India, as Indian companies start investing in foreign companies, I gave you a reference of Infosys is listed in a foreign stock exchange, correct? So, when investors are putting money in Indian companies, we have lot of foreign companies. You talk about Google, Amazon, Accenture, IBM, Bank of America, so many companies. They have their companies being set up in India. They are investing money in India. They are creating something called as global capability centers in India. They have a lot of offshore units in India. So many things are happening. So when so much of transaction is happening, India is now being a part of the overall global picture. What happens in US impacts India. What happens in let us say Japan will impact India. What happens in Russia, Middle East, it will impact India. So because of so much of global dependency and so much of global capital coming into India, you have foreign institutional investors, you have foreign direct investment. Because of all of this, the existing accounting standards were not sufficient. In a if I put it very simply, the globalization of business, the increase in global dependency, the foreign money coming to India, because of all of these, the existing standards were not sufficient, because the foreign investors or the foreign companies would say, see, your accounting standards are good, but we need financial statements as per global standards. We need comparisons as per global standards, not as per your local accounting standards. So, that is why for large companies and the listed companies, we have Ind AS, which is closely linked to IFRS, right? So, what was the need? There has been a major change in the global economic scenario. Global economic scenario, there has been a major change. The companies raise capital from all over the world and also they operate across the globe. Hence, so converge means basically, if it is something like this, you move towards a single point. Okay, that is what is called convergence. So, Indian standards should also move towards global standards, and hence convergence of accounting standards was required, which means working of a single set of accounting standards to be used internationally. Gradually, we want our accounting standards to be in line with international financial reporting standards. Now, again you may have a doubt, sir, when we are anyways going towards international financial reporting standards, then why have accounting standards again? Why do we need to create accounting standard and Ind AS unnecessary increasing our syllabus? The reason is compliance with Ind AS requires lot of effort, time and cost. Okay. So, just to give you a perspective, leases itself, when you go to CA final, it is about 130 pages chapter. There is a 1000-page document on leases published by the Big Fours. That is the level of depth what Ind AS covers. Now, do you think a small company, let us say a non-corporate entity, will they be able to comply with such a complex accounting standard? Right? There is a lot of thing about determining the fair value and the different way of accounting. They will not be able to do. You don't have the resource. You will need a lot of money. You will need a lot of time. The Kirana store will say, should I comply with your Ind AS or should I do my business? Right? So that is the purpose why we still have accounting standards which is applicable for non-corporate entities and accounting standards which is also applicable for your small and medium companies. Okay. For larger companies or listed companies, we have Ind AS. Alright. So that is why we are maintaining accounting standards as well as Ind AS. So why was it needed? Ind AS is needed. First is raising funds from international market. Whenever we have to raise money from international market, the international market or the investors in the international market would require global standards to be followed when you are preparing the financial statements. Correct or not? So every country has its own rules for accounting and reporting. When an enterprise raises capital from a market outside its home country, it must follow that country's rules, which requires understanding how those rules differ from its own rules. So if I am raising money from a foreign market, I need the financial statements to be prepared as per that market requirement. So like this, if I have to raise money from 10 markets, I will need financial statement as per those different countries requirement. That is why globally translation and restatement of financial statement became very important, and hence there was a need to move towards a single accounting standard or international financial reporting standards. Okay. So what is the meaning of this translation and restatement? Assume I have prepared financial statement as per AS. I go to a foreign banker and I say I need money. He says I need IFRS standard, IFRS based financial statement. To convert this again is time consuming. So the government said, okay, if at all you are going to list in a foreign country, okay, so what you do, you prepare financial statement as per Ind AS. Now Ind AS and IFRS, because they are 99% same, it will not be very difficult to present. It will not be very difficult to convince a foreign investor. So first is raising funds. Second, comparability of financial statement. Like we said, I want to compare Infosys and TCS. I also want to compare Tata Motors and Tesla. Of course, they are in very different business segment, but still, so if I have to compare Tata Motors and let us say, if I am not talking about Tesla, but I am talking about Toyota, two different companies in two different countries, if they follow different accounting sets of rules, if they follow different set of rules, how will I compare? So for that purpose also IFRS is needed, so that there is an internationally accepted set of accounting standards for cross-border comparison. Then there is also a need for uniformity, rationalization, comparability, transparency and adaptability in financial statements. Uniformity means present or prepare financial statement in uniform fashion. Then there was a requirement of having uniformity, comparability, transparency, etc. Uniformity means again preparing the financial statements based on same set of rules or similar set of rules. Okay. Then you have rationalization. So what are the items to be reported? What is the rationale behind reporting certain specific items for certain specific accounting treatment? There you need uniformity. Comparability we already discussed. Transparency, more and more disclosures, and adaptability means you should be able to adapt to new kind of transactions, new kind of events. So that was required. Having different sets of accounting standards around the world is against the public interest. If the same event produces different reported numbers under different standards, it creates confusion, encourages error and may even facilitate fraud. So if we have different set of accounting standards, if you have different set of accounting standards across different companies, same event may be reported differently. And if same event is reported differently, it will not be comparable. There may be a chance to do creative accounting, window dressing, fraud, etc. Hence, there was a need for a single set of global standards. And then global investment. Convergence of financial reporting supports free flow of global investment and benefits all capital market stakeholders. It improves investors' ability to compare investments globally, lowering their risk of errors of judgment. It also makes accounting and reporting easier for companies with global operations and removes the requirements of reinstatement of financial statements. So we talked about 4 benefits. You need to remember the side head and briefly explain. Why do we need global standards? Raise funds from international market, comparability of financial statements across the border, uniformity, comparability, transparency, adaptability, and global investment. See, if you see, raising funds, global investments are more or less linked, but if I have money from foreign investors, it will become easy for me to present them the financial statements that they understand. Okay, and hence there was a need to move towards a single set of accounting standards globally. Convergence can create new standard of accountability and greater transparency for all market participants, including regulators. It reduces the operational burden for accounting firms by letting them build expertise around one unified set of standards. Convergence is especially significant for companies with joint listing in both domestic and foreign markets. So what is this trying to tell us? Basically, see, if I am an accounting firm, let's say I am providing audit services or we provide accounting services. If I am providing accounting services in 5 countries and each of these countries have their own accounting standards, I have to acquire knowledge for 5 different accounting standards. But if it is a converged accounting standard, if you are looking at global accounting standards, then understanding of Ind AS will be 99% understanding of IFRS. That difference of 1%, you can anytime acquire that specific knowledge. Alright. So when you have accounting standards like Ind AS, which is closely aligned to IFRS, it becomes easier for accounting firms, for auditors, for regulators, for everybody. There is no need to prepare different set of financial statements. Or think of it, I want to list in India, I want to list in the European market. Single set of standards you can follow, right? So this is what is the need for convergence towards global standard. Now we have understood the benefits of having global accounting standards. Now we will briefly understand what are the authorities who issue these global standards and what has India done to converge towards these international standards. Okay, so like we have in India Accounting Standard Board of ICAI, we have International Accounting Standard Board. Okay, again a lot of things that we discuss now is more for your understanding. Few things you can remember, rest of the things what I tell you, you don't need to remember or put a lot of effort to by heart. Okay, so International Accounting Standards Board, what do? They issue something called as International Financial Reporting Standards. Before International Accounting Standard Board, there was an International Accounting Standards Committee which was established in 1973 to develop international accounting standards. Even ICAI is a member. Okay, now this went on till 31st of March of 2001, and from 1st of April of 2001 we had International Accounting Standards Board which issued IFRS. Before this we had International Accounting Standards Committee which issued International Accounting Standard. So right now we are talking about 2 things, International Accounting Standards and International Financial Reporting Standards. Now you may have a doubt, sir, currently do we have International Accounting Standards? The answer is yes. Do we have International Financial Reporting Standards? The answer is yes. Sir, then do company follow IAS or IFRS? They follow both. So when today we say International Financial Reporting Standard, we have International Accounting Standards and IFRS put together. So on one given area, either you have IAS or you have IFRS. Whatever new standards are being issued under IFRS series. So earlier we had IAS 17 for example, which dealt with leases. Now we have IFRS 16 which deals with leases. After IFRS 16 was issued, IAS 17 was withdrawn. So all new standards, either new standards or replacement of existing standards, will be done in the IFRS series only. So as of today, if you ask me, we have IAS 1 to 41 and we have IFRS 1 to 18. IAS 1 to 41, IFRS 1 to 18. Indian accounting standards that we are talking about, that is the Ind AS, is based on IAS as well as IFRS. So Ind AS numbering, how it goes is, if it is based on IAS, we follow the same number. If it is based on IFRS, we follow the 101 series to 118. Okay, so if IFRS 18 is there, corresponding Indian accounting standard will be Ind AS 118. Please remember, this is different from accounting standard 1 to accounting standard 29 that we will be discussing, and that is a part of your syllabus. So when I say accounting standard, it is AS 1 to AS 29. When I say Indian accounting standard, it is Ind AS 1 to 41 and 101 to 118. Of course, if new standards come in, the list will keep on increasing. Now, before we move ahead, I will just run you through the list of Ind AS, the series of Ind AS, how are they connected to IAS and IFRS series and corresponding accounting standards. The numbers of Ind AS, IFRS, IAS, you don't need to remember as of now. You will remember them when you come to final. Our focus is in remembering accounting standard series only. So as I told you, if you have IAS, Ind AS also will be the same number. For example, we have IAS 2 on inventories. Correspondingly, we have Ind AS 2 and we have AS 2 in accounting standards. Then another one for your quick understanding, we have IAS 16 on property, plant and equipment. Corresponding Ind AS is also 16. Sir, then accounting standard is 10. Accounting standard will follow its own series. 2 is linked because it is more of a coincidence that IAS 2, AS 2 and accounting standard 2. IAS 2, Ind AS 2 and AS 2, it was more of a coincidence. Otherwise, like for example in property, plant and equipment, you have IAS 16, Ind AS 16 and accounting standard 10. Okay. Subsequently, once you complete understanding of all these accounting standards, you can come back to this list and have a look at the corresponding numbers. Now, when we talk about IFRS, let us say we talk about amalgamation, we have accounting standard 14. IFRS 3 talks about business combination, which is similar to amalgamation, and correspondingly we have Ind AS 103. Then we have Ind AS 105 for non-current assets held for sale and discontinuing operation. We have AS 24 for discontinuing operation. Now, if you observe here, 3 and 5, 4 is not there. So, what happened to 4? 4 was replaced and 4 was replaced with IFRS 17. So, we have corresponding Ind AS 117. Now, the next change that is happened is IAS 1 that deals with presentation of financial statement. Now, we have IFRS 18 presentation and disclosure in financial statement corresponding Ind AS 118. Which is the corresponding accounting standard? Accounting standard 1, disclosure of accounting policies. Okay. So, like this, we have IAS and IFRS, we have Ind AS for that, and corresponding we have accounting standards for some of them. For some of them we don't have accounting standards. For example, share based payment, we have IFRS, Ind AS, we don't have accounting standard, we have only a guidance note on share based payments. Similarly, we have one dangerous standard, the most dangerous standard in CA final, IFRS 9, Ind AS 109, financial instrument, we don't have any corresponding standards. Alright. So, this is how the accounting standards, Ind AS and IFRS are linked. So, now we have understood the linkage between Ind AS, IAS, IFRS and some common standards which are there also in accounting standards. Okay. Now, just to quickly recap, IAC issued till 31st of March of 2001 known as International Accounting Standards, and the IASB issued from 1st of April of 2001, that is International Financial Reporting Standard. When we say International Financial Reporting Standards, we refer to IFRS, means it includes IFRS, IAS, interpretations issued by Standard Interpretation Committee and interpretation issued by IFRS Interpretation Committee. So, if someone says IFRS, they are referring to IAS, IFRS, standards interpretations given by Standards Interpretation Committee and interpretations given by International Financial Reporting Standards. IFRS are principle based standards. They establish broad rules rather than specific treatment, and most nations are moving towards adopting them at least to some extent. So, I explained to you earlier also, right? US GAAP is a rule based standard. IFRS are principle based standard. Ind AS is also a principle based standard. Accounting standards are also principle based standards. Okay. Now, earlier if you remember, I told you that if we have to move towards IFRS or global standards, and I also told you that we have something called as Ind AS, which is 99% almost same as IAS and IFRS. Okay. Which are almost same as IAS and IFRS. Now the question comes, sir, if it is so close, if it is so similar to IAS and IFRS, why did we not adopt IFRS as it is? Why did we not say that our companies, like let's say a London based company follows or a UK based company follows, we will also follow IFRS? Why to have this headache of having another set of standards? There are two things. One, there are some specific aspects or specific pain points of accounting in each country, each economy. Okay, that's the first thing. Second, the government also would want to have some kind of authority. Like for example, tomorrow if they want to change something in terms of accounting, if it is Ind AS, if it is in their control, they can change. But if it is in the control of IFRS, they will not be able to change. Alright, and hence we have Ind AS which is similar to IFRS. Okay, one simple example I will tell you. There is one paragraph called paragraph 46A of Accounting Standard 11. Again, don't get scared with these numbers. When we go to Accounting Standard 11, you will understand this 46A in much more detail. There is some treatment given by 46A. This treatment is not there in IFRS. Okay, but in Ind AS, this treatment is allowed in some cases. In Ind AS, this 46A treatment is allowed. IFRS doesn't allow that. Now, if the government says that you have to follow IFRS, will they be able to allow this 46A treatment? They will not be able to allow. Alright, so that is why, because of these specific cases, scenarios, what the government has thought is, okay, we will not follow IFRS as it is, we will create standards which are closely or similar to IFRS, and those are called Indian accounting standards. Again I am repeating, when I say accounting standard, I am referring to Accounting standard 1 to 29. When I am referring to Ind AS, I am referring to Ind AS 1 to 41 and 101 to 118. And of course, IFRS and IAS you are aware of now. Okay. So, if I have to become IFRS compliant, we can either adopt the IFRS as it is, we will simply declare tomorrow onwards we will follow IFRS, or we will follow the convergence process. Convergence process means we will take IFRS, we will add something, we will delete something, and we will create Ind AS. So basically IAS, IFRS plus or minus something is equal to your Ind AS. This plus or minus is called carve-ins and carve-outs. If you are adding something, carve in. If you are removing something, carve out, or a different treatment, carve out. Okay. So when we follow the convergence process, we develop high quality compatible accounting standard that align with the international standard with some degree of compromise by adopting requirements either fully or partially. So what do we do? So for that, what do? We have some carve outs, we have some carve ins. The Government of India in consultation with ICAI decided to converge with IFRS rather than adopt it as issued by IASB. The decision was taken after detailed analysis of IFRS requirement and discussions with stakeholders. Okay, so what are the differences we can see? One difference is related to terminology difference, that is usage of a different terminology. For example, in India we say balance sheet, there IFRS they say statement of financial position. Now sir, why have we not changed? Historically we have been referring to that as balance sheet. Why do you want to change it now and create confusion? Okay, then we say statement of profit and loss. They say statement of comprehensive income. But this also they didn't want to change. So this is terminology difference. Then some options are removed in accounting principles and practices in Ind AS. So one best example is under IAS 40. This deals with investment property. Investment property means land and building, something for investment purpose you have taken. Under IAS 40, they allow you to value this investment property at market value, which we call fair value. You have done revaluation model, no, under property, plant and equipment. Here they allow, but Ind AS 40 does not allow. So that is one difference about terminology, the way you use the words or the way you use the terms. Second is remove some options in accounting principle and practices. These are not called carve-outs. Sir, what is the meaning of this removal of options? a very simple example, there is one standard called IAS 40, again no need to remember, okay, which deals with investment in properties. Like if you have taken a land or building for investment purpose, IAS 40 deals with that. Correspondingly, what do we have? We have Ind AS 40. IAS 40 allows fair value option, means you can value this property at market value. Like means you can value this property at market value, like we do revaluation for property, plant and equipment. Whereas Ind AS 40 does not allow. So this is an option which has been removed. Okay. Then we have differences due to differences in economic environment resulting in carve-ins and carve-outs. Carve-outs means we have removed some treatment. Carve-outs means we are following a different accounting treatment which is not prescribed by IFRS. Okay. So we are deviating from the accounting principles stated in IFRS due to differences in economic condition. This is called as carve-out. This is called as carve-out. A simple example could be if there is any gain on business combination. Under International Financial Reporting Standards, you will take it to P&L. Here, you will not take it to P&L, you will take it to other comprehensive income. This is a difference in accounting treatment. Again, this example is only for your understanding and reference. Don't worry or no need to break your head on remembering these things. Okay. If you have understood, more than enough for your examination point of view. Then carve-ins means giving additional guidance in Ind AS over and above IFRS. I gave you a reference of paragraph 46A of Accounting Standard 11, which is continued in Ind AS. That is an example of carve-in. Removal of options, what example I give you, does not result in a carve-out. So when we are conversing from IFRS to the Indian accounting standards, there will be difference in terminologies, there will be new treatment given, some treatment will be removed, some treatment will be modified, and finally we will have the Ind AS to be implemented. So now what was the need for convergence to IFRS in India? As I told you earlier, right? Global accounting, you want to raise money globally. So due to rise in overseas acquisition by Indian companies and also overseas companies coming to India, and ICAI is a member of International Federation of Accountants, so they are also committed to aligning the accounting to the global practices. We had to converge with IFRS. For convergence of Ind AS with IFRS, the ASB in consultation with the MCA decided that there will be two separate set of accounting standards. Ind AS converged with IFRS. This is for the, as I told you, listed companies and large companies, and other AS for other non-corporate entities and small companies. What are Indian accounting standards? These are IFRS converged standards issued by the Government of India under the supervision of Accounting Standard Board in consultation with NFRA. NFRA recommends these standards to the MCA, and the MCA notifies these accounting standards to apply to companies in India. Naming conventions we have already discussed, right? Now we have an idea of what accounting standards are, what Ind AS are. Okay. Now, before Ind AS were made applicable, of course, all the companies were following accounting standards. After Ind AS was made applicable, companies had to switch to those companies where Ind AS is applicable. They had to switch from accounting standard to Ind AS. Now, it's not just overnight we can change the accounting. So the government had a planned approach. Okay, so they wanted to do it since early 2010, 2011 onwards, but there were some issues related to how we will handle that in taxation and other implications. So over a period of time they deliberated, and finally when it came to implementation, on voluntary basis companies could adopt from 1st of April, and on mandatory basis from 1st of April of 2016. This is for specified companies. All companies are not required to follow Ind AS. Voluntary, if you want to follow, go ahead, you can follow, but on a mandatorily basis, the government had decided phases. Okay, so there were two phases, phase 1 and phase 2. Over these two phases, the government said, okay, this is how you have to follow Ind AS, this is how you have to transition from accounting standard to Ind AS. Okay, so MCA issued the company's Indian Accounting Standard Rules 2015 on February 16th of 2015, and based on that a roadmap basically which company should follow, how they should follow, that was what was given. Now if you look at the phases for companies other than banks, NBFCs and insurance companies, so banks, NBFCs and insurance companies, they have been kept aside. Other than these, what all companies are there? Okay. For phase 1, which all companies had to start from phase 1? If the company is a listed company or in the process of listing in any stock exchange in India or outside India. So, a listed company. Sir, what is the meaning of a listed company? You have heard of National Stock Exchange, you have heard of Bombay Stock Exchange, right? There are a lot of companies who are listed. When I say listed, just think of it like, in the initial stages, a product is listed on Amazon. Okay, so a product is listed on Amazon, you can buy the product. Same way, when a company is listed on an exchange, exchange is nothing but a market. Okay, since it is a new terminology for a lot of you, you may find it difficult to understand it the first time. When we say listed companies, these companies are listed on the exchange. If you have an account, you can buy and sell shares in the stock exchange. So if you want, and I would suggest after you start your articleship with your stipend money, some part of it you should start investing in listed companies, but not based on tips. Study, figure out, or take the top 10 companies, top 20 companies in the country, buy some shares of those companies, you will be able to understand and appreciate the process better. Or if you right now also get a decent pocket money, and if you want to save something out of that, maybe buy some 2-3 shares of Reliance Industries or some ITC or some Infosys. Not an investment recommendation, just for you to understand the process. Okay. So if any company is listed or is in the process of listing in any stock exchange, whether in India or outside India, and a net worth of more than 500 crores, more than or equal to 500 crores, to them Ind AS was made mandatory in the first phase for accounting period beginning on 1st of April of 16. If a company is not listed, it can be a public company, it can be a private company. If it is a not listed company, net worth of 500 crore or more was to be checked. Okay, sir, here also we are saying net worth of 500 crores, here also we are saying net worth of 500 crores. They could have simply said all companies with net worth of 500 crores or more have to follow from 1st of April of 16. That also they could have done. Okay, the reason why they split is, in the second phase, all listed companies which were not covered in phase 1 were covered in phase 2. That is why they have done the split. Whereas for unlisted company, the criteria was set to 250 crores. So this can be sometimes confusing. If you ask me, as on today, sir, what is the rule? I'll tell, all listed companies have to follow Ind AS, irrespective of their net worth. But if a company is listed on SME exchange, they are not required to apply Ind AS. I hope it is clear. Whereas if a company is unlisted company, means it is not listed on a stock exchange, it can be a private company, it can be a public company, they will follow Ind AS if the net worth is 250 crore or more, and they will follow Ind AS if the net worth is 250 crore or more. So as of today, you have to check the net worth 250 crores or more, follow Ind AS. Listed companies follow Ind AS. If you are listed on SME, no need to follow Ind AS. I hope it is clear. Okay. So the split was given basically because in the second phase all listed companies were covered, whereas for unlisted company we have a threshold of 250 crores. Then any holding subsidiary, associate or JV of these companies also need to follow Ind AS. Sir, what is a holding company? What is a subsidiary company? Gradually we will understand. Okay. This was from 1st of April, this was from 1st of April, this was from 1st of April 16, this is from 1st of April 17. Okay. Apart from that, if a company wants to voluntarily adopt Ind AS, they are free to do it. Okay. This is with respect to companies. Once Ind AS is applicable, all entities, an entity shall be required to follow Ind AS for all subsequent financial statement. Means once you have followed, once you have prepared financial statement based on Ind AS, then there is no looking back. Then you can't say from Ind AS I will go back to accounting standard. No, Ind AS forever you have to follow Ind AS. Okay. Companies not covered by the roadmap shall continue to apply accounting standards as notified in the company's accounting standard rules. Okay. So that is the second thing. Then for NBFCs, then for NBFC again similar criteria is there, but date is first phase 18, second phase 19. Voluntary adoption of Ind AS is not allowed for NBFCs. So if there is a non-banking financial company, sir, what is this non-banking financial company? If we talk about a bank, bank can accept deposit, demand deposit, and they lend money. Correct? SBI, HDFC, ICAI. But let us say you go to Manappuram, gold loan, or best example, you have Bajaj Finance, no? Bajaj Finance gives personal loans, or they give consumer loans. Okay, they also give housing loans, right? Their job is they give loans, they borrow money, they give loans. They don't accept demand deposits from the public. They cannot accept. Only bank can accept demand deposits from public. Okay. So if it is a finance company, if it is a financial company but it is non-banking, then this roadmap has to be followed, and voluntary adoption is not allowed. Then coming to commercial banks. Now coming to commercial banks, RBI has deferred the Ind AS implementation till further notice. So hence they are not required to apply Ind AS. So any banks you talk about, RBI has not yet notified. So if you look at a bank, let us say HDFC Bank, they will prepare financial statements following accounting standards plus banking norms. For insurance companies, also they have deferred the implementation of Ind AS till further notice. So as of now, NBFCs have to follow and other companies have to follow. Banking and insurance companies are not required to follow Ind AS. Now, one thing I'll tell you towards the end of this session. Now, one thing I'll tell you again, that we have talked a lot about IFRS, Ind AS and all. It is more from your understanding perspective. Don't be scared, sir, how to remember so many IFRS numbers, Ind AS numbers and all of that. Not required. You are required to remember and you are required to understand, remember accounting standards, and that also at a CA intermediate level. For some standards, there are high level concepts which we don't need to go in depth. Okay. So don't try to do a PhD. Like for example, accounting standard 15. There are a lot of concepts. If you start digging into each and every concepts in detail, you will never be able to complete the syllabus. So trust me, trust my process, trust our notes. Whatever is required for you to understand the standard and to appear in the examination, pass the exams with the flying colors, we will do everything necessary. But we are not doing PhD now. We will teach you conceptually. Every concept will not be covered in so much of depth. Otherwise, these classes will be 400 hours of lectures. Okay, so that is one thing you have to understand. Yes, of course, whenever you have a doubt or if you want to understand something extra, you can always ask. You are free to ask. Anytime you ask, we will respond with a proper explanation, example, anything is required, that will be there from our side. But if you start looking at this subject and that, sir, I want to master everything, I want to be expert in everything, the objective of completing this CA intermediate in the available 8 to 9 months time cannot be met. Okay, so whatever we do in the class plus all the questions that we solve in the class plus the study material question, the past exam questions plus RTP, that is more than sufficient. And whenever you want, you can do some research, you can read more books, you can read online, you can see what companies are doing. I told you, right, read annual report, not from the point of view of an examination, from the point of view of understanding how those annual reports are prepared. Alright, so this concludes introduction to accounting standards. Okay, now two scenarios are possible. If you are watching it at the beginning, that is as a first chapter, then you may have to revisit this chapter after you complete all the accounting standards. If you have completed all the accounting standards, no need to worry, you are in a perfect situation currently.